Good morning, everyone. To begin, let's address our first question. What is money laundering? As shown on the slide, it is the process of converting dirty money, which means the proceeds of crime, into clean assets. The main goal of criminal is to disguise the illegal origin of these funds, making them look like legitimate income, so they can use them without raising suspicion. This is a massive issue for three reasons. First, the scale is enormous. It accounts for an estimated 2 to 5% of global gross domestic products, which is up to 2 trillion US dollars annually. Second, it directly fuels crime by funding terrorism, drug trafficking, and corruption. Third, modern technology allows these illicit funds to easily cross global borders instantly. To address this, our presentation objective today are to break down the three cores of money laundering, analyze its negative social and economic impacts, and explore key prevention frameworks with a specific focus on Malaysian AMLA laws. Now, I will pass the floor to Atif to take us through the history and background of where this term originated. Thank you.
Money laundering became common in the US in the 1920s. During that time, alcohol was illegal. But people still wanted alcohol, so criminals sold it secretly. This made crime groups very rich. One famous criminal was Al Capone. People say that he used laundromats to hide illegal money. The money from the crime was mixed with the money from normal laundry businesses. So the illegal money looked legal. Before 1980s, the money laundering was not seen as a big crime. Al Capone was actually jailed for tax evasion, not money laundering. Later, drug dealers also made a lot of illegal money. But before 1986, some drug dealers could still keep the money after jail. At first, the government focused more on drugs. Later, they realized they also had to stop the illegal money. That is why money laundering laws became stronger.
So how money laundering works? Money laundering is the process of converting illegally obtained money into money that appears legal. So it involves a series of steps designed to hide the source of the funds and make them difficult to trace. The process generally consists of three stages: placement, layering, and integration, which together help criminals disguise the origin of their money and use it as it were legally earned. So as you can see in the flowchart, the first stage is illegal activity. So the money is obtained from the criminal activity like drug trafficking and also corruptions. So the second stage is placement. Illegal money is introduced into the financial system like bank deposit and also the cash intensive business. And then the third stage is layering. The money is moved through multiple transactions to hide its origins, like involved in transfer between multiple accounts and also the currency exchange. And the fourth stage is integration. Money re-enter the economy as apparently legitimate funds, like involved in real estate investment and also business investment. And the last stage is clean money. The money appears legal and can be used freely.
So the placement. So we go to the definition first. The placement is the first stage of money laundering, where criminals introduce illegally obtained money, such as dirty money, into the legitimate financial system to make it harder to trace. Next up, method what they use. So they usually depositing small amount of cash into the bank accounts and sending money through money transfer service or into foreign bank account. So for examples, an owner of a cash intensive business makes illegal cash with daily sales revenue. For the other example is a drug trafficker deposit 9,000 RM at several different bank branches to avoid reporting requirements.
So the next method or next procedure for money laundering, which is layering. So the purposes for layering is a method to create a confusing paper trail in a complex way that will make investigators cannot follow it, the money transaction. And how the layering is function, the criminals will bounce the money through international wire transfer, convert it into different currencies, or hide it behind anonymous, which call shell companies, and which are fake corporations that exist only on paper to mask who truly owns the money.
Integration is the third and final stage of money laundering. At this stage, the money has already gone through placement and layering, making it difficult to trace back to its criminal source. The laundered money is then reintroduced into the legal economy and appears to be legitimate. Criminals may use this money to buy properties, luxury vehicles, or invest in businesses and stocks. For example, a criminal may use laundered money to purchase a restaurant, allowing illegal funds to mix with legal business income. Once integration is successful, the money can be used freely without raising suspicion.
Effects of money laundering. First, the effects on economy. Reduce economic growth because illegal funds are often invested in unproductive activities. Distorting financial markets, making it difficult for legitimate businesses to compete. Secondly, is its effects on social. Encourages criminal activities such as drug trafficking, corruption, and organized crime. Increases corruption by allowing criminals to bribe public officials and avoid law enforcement. The third one is its effect on businesses. Companies linked to money laundering may lose customers, investors, and business partners. Companies may also face fines, legal action, or closure if they fail to comply with AML regulations. Lastly, the government. Tax income loss as criminal proceeds are often hidden from taxation. Laundered money may be used to finance terrorism and other activities that threaten national security.
AMLA was introduced in 2001 to prevent criminals from hiding illegally obtained money within the financial system. Under this law, banks and financial institutions must verify their customers' identities and monitor transactions. If any suspicious activity is detected, it must be reported to the relevant authorities. AMLA also gives enforcement agencies the power to freeze and confiscate assets connected to criminal activities. Bank Negara Malaysia plays a crucial role in enforcing anti-money laundering regulations, as the country's central bank, BNM, supervises financial institutions to ensure they comply with AMLA requirements. It provides guidelines, receives suspicious transaction reports, and takes enforcement action when necessary. BNM also works with domestic and international organizations to strengthen efforts against money laundering and terrorism financing. So, a notable example is the 1MDB scandal, where billions of dollars were allegedly misappropriated and moved through various financial channels. The case demonstrated the importance of strict anti-money laundering measures and effective regulatory oversight by authorities such as Bank Negara Malaysia.
In conclusion, money laundering is the process of concealing the illegal origin of money to make it appear legitimate. It generally involves three stages, which is placement, layering, and integration. This crime enables criminals to enjoy profit from illegal activities while avoiding detection. Money laundering can have serious impact on society, including supporting organized crime, corruption, and economic instability. Therefore, strong regulation, financial monitoring, and public awareness are essential in preventing. By understanding money laundering, we can better appreciate the importance of maintaining a fair and transparent financial system. Thank you.